Okay, so we left off having looked at our corporate tax rates. Now we're going to do something that we've done before. So same deal, Andrew. Post, like, the best thing to do with that is post your question on the forums, and you'll see in the forums actually a couple people have posted their Excel spreadsheets for it that aren't quite the right answer but are close, and that's a helpful thing for that. Okay. All right. Okay, so good. Find the forums. You'll see that there is somebody who recently posted an Excel spreadsheet, and it gives you a good starting point. Okay. And there's a lot that's missing, or you can post your own Excel spreadsheet and I'll show you what's missing. I'm fine with that too. All right. And the questions that are there, they're not for my enjoyment or whatever the case is, right? They are there because that's the kind of thing you're going to see on your CFP exam. So the questions are all there for a reason. All right, so we're going to do a little review of dividend tax. We did this once already back in chapter 9, but we need to do this again because it gives us a useful foundation. So we're going to just go back to what I had before the break. We had this corporation with revenues 3.1 million, expenses of 2.4 million, net of 700,000. Okay. We have a Nova Scotia resident. And we said on the first $500,000, we're going to pay tax at 11.5%. So this is all on the last slide. I don't want to revisit every single thing here, which was $57,500 of tax. And we said in our LRIP then, we still had $442,500. Okay. And then on that amount over 500,000, so that's 200,000, we're paying tax at 29%, which is a pretty high corporate general tax rate. That's $58,000. And as a result, in our GRIP, we have $142,000. Okay, that's all good. So now let's go find ourselves a Nova Scotia taxpayer. Okay, and it doesn't matter what tax bracket we use. Do we want somebody at top tax bracket or do we want somebody at a lower tax bracket? Top tax bracket. All right. So Nova Scotia, our top tax bracket is around 54%, exactly 54%. Okay. So the way that I'm going to do this, I don't want to deal with $700,000 of income. Is everybody with me here? That if I dealt with $700,000 of income, that I would have to do some income at the bottom tax bracket and some income at the second tax bracket and some income at the third tax bracket. And Nova Scotia has 10 tax brackets. So we don't want to do that, do we? Can I just do the top tax brackets? So here's what we're going to work with. We're going to isolate $1,000 of income in the top tax bracket. Okay. Everybody's good there? So if I'm a business owner in Nova Scotia and I pay myself salary on that, I'm going to lose 54% to tax. I'm going to be left with $460 net of tax if I took salary. Does everybody agree with that? If I could just carve out a narrow chunk of $1,000 out of this person's overall tax picture. Nobody wants me to do 10 tax brackets of calculations. Is that a fair comment? We've done those tax bracket things before. If you need to revisit that, you go back to chapter 7. All right. So then, okay, that's what I thought, Bev. So now let's compare this to a dividend from the low rate income pool. Okay, this is going to be a non-eligible or ineligible dividend. Okay, so the first thing that would happen is our dividends are paid out of our after-tax dollars. So $1,000 of salary is not the same as $1,000 of dividend. $1,000 of salary would be deductible, whereas $1,000 of dividend is not. So I have to do an apples to apples comparison here. I take 11.5% off of that $1,000, and that knocks us down to $885 would be the corporation's after-tax amount. Okay, at the small business rate. Is everybody with me there? So paying myself $1,000 of salary is the same as paying an $885 dividend out of the small business amount or out of the low rate income pool. Would everybody agree that that's an apples to apples comparison? Because the dividend is not paid as a deductible amount, whereas a salary is. Okay, Bonnie's with me here. Anybody else? So paying $1,000 of salary is the same net cost to the corporation as paying $885 of non-eligible dividends, Melanie, right? Those two amounts would be the same net effect to the corporation. So to get an apples to apples comparison, that's really what I have to compare. Okay, thanks, Carla, good stuff. So now I'm going to take that $885 and I'm going to tax it the dividend way. So what's the first thing I have to do with a dividend? To gross it up, Esther. Beautiful. So I'm going to gross it up. And my dividend gross up for a non-eligible dividend this year is 15%. Okay, which should bring me to just a little over $1,000. So now I'm working with a dividend that's going to show up on my T5. That's going to be $1,017.75 on my T5. That's the grossed up amount. Okay, everybody's with me there? Now, can I just round it off to $1,018? Okay, so we're going to round that off to 1,018 just for the sake of not having to fight with 75 cents. And now I'm going to do two things with that grossed up amount. First thing I'm going to do is apply my tax rate. So again, we're at a 54% tax bracket. Okay, so I take $1,018 times 54%, I get $550. That's the amount of tax that I'll have to pay on that dividend. What's the other thing that I have to do to get to my tax? No, so this is personally, I paid the dividend. I paid $885 to the shareholder. So I have the dividend tax credit, Bev. Perfect. And that dividend tax credit in Nova Scotia we're going to take a 9% federal tax credit and a 3% provincial tax credit. And those are just what the numbers are. So that's a 12% credit in total. Okay. So I have $1,018 times 12%. That gives me $122 of tax credits. Okay. So my net position here, what was the actual amount of dividend that I got? What was the check the corporation wrote to me? The amount paid was $885. Okay. So there's an $885 dividend paid. And then we have to pay $550 of tax. And then you're going to get a tax credit of $122. Right. So this is paid to the shareholder, right? So that's when we talk about getting a dividend, Sean, this is it. This is what we're looking at. Okay. So now I've got $122 of credits. So I just sum all those amounts up. And I get $428 net of tax. Okay. So a little bit less than if I had taken salary. Okay. Slightly less than if I took salary. Okay. Any questions there? Now, that's a little bit off. That's actually, yeah, in fact, it's a little disadvantage, Bonnie, right? And part of the reason for this is because Nova Scotia is not fully caught up on changing its tax rates as the dividend tax rates change. So that was tax paid. That was the corporate tax paid, Melanie? Because your dividend is paid out of your after-tax dollars, right?
Sorry, just way quicker to jump on here. So is what you're saying is you pay the $1,000 to you as a dividend, but really what hits your pocket is $885 because you're paying 11.5 corporate tax.
Nope, I'm not saying that. I'm saying, well, okay, maybe. I guess it depends. I'm saying the corporation made $1,000. So the corporation sold $1,000 worth of whatever crap it sells, right? Mm-hmm. And then on that, we paid 11.5% tax. Mm-hmm. So after tax, the corporation has $885. There's $885 that's burning a hole in your bank account.
Right. I don't know why that was so hard for me to grasp. It's very
fine.
simple.
Yeah. It's,
okay.
It's 5 o'clock, Melanie. Thanks. Right. Okay. No, the dividend was actually worse, Esther, wasn't it? The dividend came to 428. The salary came to 460. Salary was better here, wasn't it? Yeah. Okay. Then we'll compare it to a dividend from the general rate income pool. Yeah, so exactly right, Stephen. Now at the top tax rate, you're well out of CPP here, right? So I don't like the CPP comparison at this point, but yes, in general, when I'm comparing dividends to salary, that's something to think about, is where does Canada Pension Plan show up in there? We'll come back to that, Esther. We'll come back to that. We'll do some math. We'll do a little more math here. Okay, but it is a good question. Okay. All right. Compared now to a dividend from your general rate income pool. Yeah, that's pretty common, Carla. So we've seen corporate tax rates messed with pretty much every year since 2005. Okay. And it always seems good when the government reduces corporate tax rates, right? The problem is when you change the corporate tax rate, then you have to change the dividend gross up and credit. And then every province has to change its gross up and credit as well. So you're really assuming when you change those tax rates that every province is going to be right on top of those same tax changes. And that almost never happens. Okay. Manitoba for years and years and years actually was famously lagging in adjusting its tax rates. Manitoba has had actually until about 2 years ago, had all kinds of things in its tax act that were wildly inconsistent to federal tax. Ontario now has done this. Ontario has a bunch of stuff that it has actually deliberately said we're not going to change to match what the federal government is doing. Okay, so it's a weird sort of disconnect, Carla, where you get the provinces at a little bit of a, I don't know, whatever it is, a left-hand, right-hand problem compared to the federal government. Okay, good. Yeah, it is very normal to have like a year of lag. If we would go about 3 years with nobody ever changing a corporate tax rate, we would probably get proper integration. Okay, just because by then everybody would be able to adjust all their sort of secondary effects and we would really integrate. But right now, no, we are not properly integrated. There's a lot of this kind of thing. All right. So then our eligible dividend. It's not, no, not necessarily, Bonnie. No, I would not say that. Okay, so once again, same deal. We're compared to $1,000 of salary that would be deductible. Okay, this time I'm paying it out of the top tax rate, out of the corporate general tax rate. So that is 29%. So I really should be comparing this to a $710 after tax amount. Okay, that's good. And this time we're dealing with a different gross up and credit mechanism. Okay, this time that $710 will get grossed up to 38%, or grossed up by 38%, sorry. So now I take 710. And the T5 amount is going to be $979.81. Let's call it $980. Okay. That's good. And now the same thing, we're going to take that. So that's what you do for eligible dividends. That's the eligible dividend gross up, Ksenia. Right? Nothing like having two different sets of rules. And we'll take that $980 again, times our 54% tax rate. Which gives me $529 of tax to pay. Okay, and then I take the same $980, and once again, I'm going to apply our tax credits. So this time, the tax credit is 15% federal plus 8.85%. No, sorry, yeah, 8.85% provincial. A combined total of 23.85% tax credits. Okay, so I take $980 times 23.2385 gives me $234 of tax credits. Okay. And now we can finish this out. We say we started at a dividend of $710. That's the actual dividend. That's the check I got from my corporation. And then we would subtract $529 of tax, and then we would add $234 of credits. And where do we end up? Anybody want to take a stab at where we end up here? Well, not great. Yeah, $415. So we're at $415 net of tax. This makes me regret choosing Nova Scotia. Okay. Because Nova Scotia honestly is badly out of line with integration. I never realized this. I never realized just how bad it is in Nova Scotia. Okay. Because, Esther, the left-hand credit was on the non-eligible dividend, and the right-hand credit is on an eligible dividend. So those are two different kinds of tax credits. So, Sean, what I have compared here is your after-tax position per, let's say, $1,000 of income in the top tax bracket if you take salary or dividends. Okay. So my after-tax position, if you want to look at it this way, per $1,000 of corporate earnings, if I took salary, I'm left with $460. If I took a non-eligible dividend, I'm left with $428. Go ahead.
I think what's confusing is, and maybe I'm wrong here, but on your second column, you have 1,000 of salary as deductible.
Yeah, it would have been deductible. So again, what I'm trying to show there is that I can't compare $1,000 of salary to $1,000 of dividends, right? Is that a true story?
I'm kind of confused by that though. Like, so scenario one, you're taking $1,000 of you're not incorporated, you get $1,000 of income.
No, I'm incorporated in this first scenario. So if I took $1,000 of salary,
right?
Looking away over on the left side here.
Okay, that's what you'd be at 460 net after tax.
No, say that again.
So on the first scenario, you take $1,000 salary from the company, you have
Okay, no, but just back up even a step further than that. Okay. If I took $1,000 of salary, that reduces this to $699,000. It's all deductible, right?
Right.
Okay. Agreed? Because it's a deductible expense. That's exactly right. But if I take $1,000 of dividend, it doesn't change that 700,000.
Totally, yeah.
So I have to compare the after-tax amount paid out of the corporation to the the after-tax amount of dividend. or the after-tax amount paid out of the corporation as a dividend, I have to compare that to the pre-tax amount that's paid as salary.
Okay. Oh, so corporate tax paid. I get it. Sorry. So you get the $1,000 in profit, and then you're going to get taxed at 11.5%. So it's equivalent to 80. Okay. Sorry. I got it now.
Okay. Yeah. So I just have to compare. So really, $1,000 of salary is the same cost to the corporation as $885 of non-eligible dividends or $710 of eligible dividends.
Okay.
Okay.
I don't know. I missed that. Sorry.
No, it's fine. Yeah. So those are all, and I can jot that on the board here somewhere. That's fine. So
Even a circle at maybe the 885 and the 1,000. Just I think if we look back, everybody will.
what did I say? 885 of non-eligible dividends and $710 of eligible dividends. Okay. So those are all going to put roughly $460 into my pocket. Honestly, the 415 is tough. That is a real strong reason not to pay yourself dividends in Nova Scotia. Okay. There really isn't, Bev. Okay. There really is not. The advantage to that lower tax rate, okay, is simply that it leaves more dollars in the corporation. So the policy reason for that 11.5% tax rate is that it allows a small business to reinvest more money into its growth. And the idea is that's supposed to give you a sort of kickstart to your growth. And the idea is the 11.5% is supposed to be sort of a temporary measure to allow corporations to grow to be 29% corporations. Yeah, it does function as a tax deferral. Andrew is correct here that tax rate functions as a tax deferral. The 11.5% tax bracket is only useful to the extent that you leave money in the corporation. If you strip every dollar out of the corporation, these tax deferrals are useless. Agreed? Okay. I feel like something went wrong with my left-hand calculation. Just bear with, what did I do wrong in my math on the left side in the pink and black? Something is not right there. 2018, we're at a 54% tax bracket. Use the right tax credit. Yeah, I just did my basic math wrong. Nice, Todd. All right. I just did, sorry, this should be $457. I just made a math error here. Looking at the numbers, and I knew it didn't make sense. 885 minus 550 plus 122, 457. There, that's so much better. All right. I think you're right, Janelle. Thanks. So the non-eligible, that should be 457. And now I got to go check my other math too, don't I? 710 minus 5. $415, so far off. Okay. Yeah, so there are lots of questions here, Sean. I'm not concerned yet about the exact question you're going to have. Okay. That's not really the point here. We need this to really have the rest of our discussions. So for most of the next 5.5 days that we spend, or I guess 5 days now that we spend together, we're going to keep coming back to this. Okay, so this by itself is not really your examinable concept. Okay, this is a foundation for about 30 different conversations we're going to have over the next 5 days. Okay, that's good. Yeah, it'll be posted tonight, Todd. Yeah. Okay. Nice. I don't know, 5 to 10 years, Stephen. Okay. And to be fair, Nicole, they may have been. Okay. Today in Alberta, dividends actually are a little bit more favorable when you take your Canada pension plan into account. But ignoring Canada pension plan, if you want to fund Canada pension plan, dividends in Alberta today are less favorable. Okay. Okay. Oh, I feel like you were asking, I thought you were asking me, Stephen, how long it takes for the corporation to really have its full effect. I see. Okay. Yeah, that used to happen, Bonnie. Now we're better at that. But there was a time, it's true, when people used to use their corporation, leave income in their corporation as a means to hide income from the family courts. But the family courts won't let that fly today. If you have somebody who owns shares in a corporation, we're going to get their financial statements, and spousal support and child support are both based on your income earning capability today rather than on your T4 or T5 income. Okay. But there was a time, Bonnie. Yeah. Okay. Yeah, that is a good question. All right. That's one good of the 30 different conversations we're going to have about this. Okay. I'm still shocked at the 415. That still doesn't seem right. $41.5%. That's right. Crazy. Okay. It's right though, Melanie. I actually, here, I'll show you this. So, so if you do the effective tax rate on this, okay, effective tax rate, you would say you started at $710 and you lost 415 to tax, divided by 710. So you ended up paying tax at a rate of 41.5% here, if I'm not mistaken. Yeah, 41.5% is your effective tax rate, which is a good thing to know anyways on dividends. And then if we look at over here, your effective tax rate, that is we started at 885, not 855, Janelle, right? And we lost 457 to tax, divided by our 885. Okay. And I get 48.3% or 48.4% effective tax rate. Okay. Everybody's with me there? So I'll just jot those down in the chat box so we have them handy. I said 41.4% 5% effective tax rate on eligible dividends, and 48.4% effective tax rate on non-eligible. $415, what you have net of tax, Esther. Right? I've got 415 net of tax. And I have that in the bottom left too, Esther. You see the blue, the bottom left? You with me, Esther? Where did I say I lost 415 to tax? It's a big difference, Melanie. Yeah. I don't think I did say I lost 415 to tax. Okay. I think I was just going through the math in my head. I said 710 minus 415 is what we lost to tax. Okay. So the subtraction, 710 minus 415, 295 is what I lost to tax. I got you. Okay. I'm going to get rid of this now. Can I get rid of this screen? Okay, I'm getting rid of this screen. All right. And I'll show you. Yeah, it's a big difference. Absolutely, it is, Melanie. And I'll just show you the confirmation I have. So this is from taxtips.ca, which of course you've all seen me refer to before. Yeah, that's kind of what was, I think, Carla's question before, right? Is why is it so different? But I'm going to blame Nova Scotia and frequent changes here. And you can see the tax rates down here. I remember I took off some pennies, right? I rounded off some pennies right at the beginning, which is why I'm not perfect. But we said 41 point, what did I have in the chat box there? 41.5% effective tax rate. Here it's 41.6%, whatever. Dorothy Kelt, Stephen, an amazing lady out of Vancouver. Okay. And then 48.28%, and we got 48.4%. So for the pennies we took off at the beginning, that's how I got those slight differences, but there we go. Okay. Good. So yeah, at the top tax rate in Nova Scotia. Oh, okay. I haven't read that one. That's good. No, other way around, Melanie. Other way around, right? We saw the largest after-tax amount was still on salary, right? Oh, no. Okay.
Jason, can you follow me through on that math? I just don't understand why these numbers, because one, you're using a grossed up number.
Yeah.
For the effective tax rates. So they don't really mean a lot. I mean, one you're using 720, the other one using 885.
Right. But when I take into account corporate tax and personal tax, I get to the same net effect, right?
I just don't know how we're reading them, I guess. I'll figure it. I'll look back.
Well, okay. I'm not sure if I understand the question, but I'll bring up the.
Like if it was all $1,000 and you said we're going to lose 4,158 or $415 in tax and 482 in tax, but you're not using the same $1,000. You're using one for 720 and the other one for 885, right?
Right, because I can't use this. Like if I use $1,000 all the way through, that's a bad comparison, right? Because it's not $1,000. Okay.
No, and I realize, yeah, just that I don't know I know that is the effective tax rate, but it doesn't really.
Okay.
mean.
What I need you to see here is that there's not a big difference between paying myself salary and paying myself dividends. If you're going to have one takeaway from this, it's that my after-tax, and especially the top two numbers here, the top two numbers are actually pretty close to integrated. We're good here, right? So if I have $1,000 of corporate earnings and I pay myself a salary, I end up really $460 ahead. If I take that $1,000 of corporate earnings and I pay myself dividends out of that, I end up $457 ahead. That's integration, right? I can't compare taking $1,000 of salary though to $1,000 of dividend. They're not the same thing. Okay. The first line under your red circle says we don't gross it up. You're talking about back on the tax tips page here, Sean? Yeah, so she's got both amounts there. She's got the grossed up amount and the non-grossed up amount. So in this case, Melanie, that's kind of how it works out, right? It's not to say that salary is always going to work out better than dividend. So don't make that connection in your head. It just happens to be here that when we take into account the fact that there's only that 54% personal income tax and no corporate tax, it happens to work out better than the scenarios where we have some corporate tax and some corporate tax and some personal tax. Okay. So the unfortunate thing here, Melanie, is that you have to do the math in every case. Good. Now, it's not going to be you doing the math. Who should really be doing the math for this? Yeah, your accountant. And your accountant has a worksheet for this. Okay. There's a site called taxtemplates.ca. By the name of Jay Goodis runs a site called Tax Templates, and he has Excel templates you can download to do pretty much every typical income tax calculation. Good. Okay. So is everybody with me on the fundamental idea of integration? That there is no big advantage to paying dividends or salary, that in the end, when we take into account the total amount of tax payable, we're going to end up in a pretty close position. Okay, where do I not have corporate tax, Esther? Tell me where I don't have corporate tax. Yeah, it takes some time, Bonnie, right? Yeah, I was just confirming, Andrew. I was confirming my math because I didn't like the number I had there before. Okay.
Sorry, I was confused. I thought that math was supposed to justify, because it looks like the 448.4, you're paying more taxes than the other one when it's the opposite. But anyway, I know what you're doing. You were checking to see if the effective rate was the same. If it
That's the
matched.
tax tips page. Yeah, that's what I cared about. Okay. Yeah, sorry, Esther, where do I not have corporate tax? Yeah, because salary is all deductible to the corporation. Esther, if my business owner here paid themselves a $700,000 salary, okay, look at the top left of the page for a second with me here. Could this person pay themselves a $700,000 salary? Is that possible? Yeah, that is, right? Yeah, okay. And if they did, then how much corporate tax would they pay? If they pay themselves $700,000, they would pay no corporate tax. It's all deductible. That's why I say there's no corporate tax on salary, because your salary is deductible. That's what deductible means, right? Is you're not paying tax on it. Okay, good. Exactly that, Bonnie. You're not paying any corporate tax. In that case, you're only paying personal tax. All right, perfect. Exactly that, Esther. Yeah. And the combined effects of those two things will always be very close to the same. Although we saw a little bit of a delta there with those Nova Scotia folks. Okay. Now, let's switch gears. And now we're only going to look at corporate tax. We're going to park personal tax for a few minutes and only look at corporate tax. Okay. And this ties into, Andrew, your comment a few minutes ago about the sort of value of the small business deduction and how this is a form of tax deferral, right? Well, honestly, today, Esther, if you're using any kind of decent payroll software, salary doesn't cost you anything to do. Okay, if you're using like QuickBooks Online or any of the, I don't know, SAP or whatever the case is, you're already going to have other staff, right? So it costs you next to nothing to pay salary. Dividends is not much more than that. Dividends, you might end up paying your accountant, whatever, $50 to write a T5 for you. It's not a big deal. Okay. That's awesome, Janelle. You're getting rid of the HHR. All right. Okay. Janelle's going to sell her truck. Okay. We convinced her this morning. So we have to look at, yeah, we're going to get there, Andrew. We are going to get there. All right. And there are good reasons. And mostly they are partly because of factors beyond your control. Okay. So hang on to that thought. All right. So small business deduction. So remember, this is this lower tax rate. Okay. 9% in Manitoba. Okay. And up from there to a maximum of around 15%. Okay. It's a very low tax rate. All right. So obviously it's attractive, but then keep in mind, once we take dividends into account, it's not that helpful. Right, I only point out 9% in Manitoba because it's crazy low, Andrew, right? Okay. So once we take integration into account, it's not useful, okay? So the idea here is something like this, and this is what I had pointed to before. If you have earnings of $400,000 a year, just for the sake of argument, okay, and you're losing only about 12% to tax, which is about an average number, you're losing about $48,000. That's right, so you're keeping $352,000 in the corporation to grow the business, okay? Whereas if you didn't have the small business deduction, okay, if you didn't have the small business deduction, you would end up losing about 25% of this to tax. You'd lose $100,000. And now you have $52,000 less to use back in the business. And if we take into account compounding, that's a big difference, right? So we like the small business deduction to the extent that we're leaving money in the corporation. And that's what's intended to happen. That's what's supposed to happen here. Okay, so clearly we want the small business deduction. That's fair? Okay. So let's say that I recognize all of this and I'm running a business. And in fact, I'll use former Business Career College as an example here. Okay, so I've got BCC. And let's say for the sake of argument, BCC is doing $3 million of revenue every year. Okay. And let's say for the sake of argument that we have $2,200,000 of expenses. Okay. And so we've got $800,000 of net income, which means $500,000 taxed at the low rate. That's right. And $300,000 taxed at the high rate. Okay, everybody's good there? Okay. Well, the problem, Esther, is where do you get those deductions from, right? And still, at the low rate of, or at the high rate of 25%-ish, that's still less than personal tax. Sure. To pay the CEO, though, cost the CEO 48% on the dollar, right? So 25% is still a lot less than 48%, isn't it, Esther? Right. You're always paying some tax. How about this, though? What if I did something like this? Let's say for the sake of argument, just because this happens to work out perfectly, let's say for the sake of argument that of this $3 million, let's say 1.6 million is LLQP and 1.4 million is CFP revenue. Okay, so here's my brilliant idea. I am going to take Business Career College. So Business Career College owned by Bob, Penny, and Jason. Okay, so the Watt family here owns Business Career College. Good. And this isn't quite true, but let's say for the sake of argument, we're 33% each, just so we have an example here. Okay. And we take the corporation, we take BCC Co. and we split it up. And there's a freeze transaction we can do called a butterfly transaction, which costs you about 25 grand to do, but you can split a corporation up into its two entities. Normally where you'll see it is when people have to split their corporation to separate, to divorce. But we're going to do a butterfly transaction, okay? And we're going to leave this structure in place. Tell me if this is going to be good. Or maybe more accurately, tell me if you think the Income Tax Act contemplated this. So I'm going to set up two different corporations. Nice, Grant. Okay. I always find the butterfly freeze a funny thing, but it's a real transaction. All right. And I'm going to set up two different corps. I'm now going to set up BCC CFP Co. Okay. And BCC LLQP Co. Okay. And BCC CFP Co. has $1.4 million of revenue and let's say $1.1 million of expenses. And BCC LLQP Co. has $1.6 million of revenue. And what do I have left for expenses then? 1.1 million of expenses. And now we have $300,000 of active income and $500,000 of active income. Have I outsmarted the tax man? Sherry knows better that I have not, in fact, outsmarted the tax man. And what the tax man is going to say, he's going to call me up and say, Jason, these are what we would consider to be connected corporations. They have the same ownership group. And because of their position as associated corporations, and because of their position as associated corporations, you have to share the small business deduction. because you have the same ownership group here. Okay, so I haven't achieved any benefit as far as my tax payable. Okay, yeah, super easy, Andrew, because when you file your tax return, you have to show your beneficial ownership. So yes, this is a pretty easy one. And we have some cases that have gone through the tax court where people have tried clever versions of this, where, for example, I take myself out of one of the mixes and I put my spouse in as one of the owners. That kind of thing doesn't work either. Okay. Yes, perfect, Sherry. That's a great example. Painful, but true. Okay. Yeah, and there are some unintended examples of that, just like what Sherry's talking about here. Okay. All right. Yeah. Nicole, the Income Tax Act beat you to it, though. Good. All right. But Sherry's example is exactly right here. You get people caught up in this kind of thing when they figure they're being clever or when they have some other connection they didn't think about to another corporation. You would hope so, Esther. Yeah, you would hope so. A good CPA is going to do that. So you would never butterfly for this reason, Ksenia. Remember I said you would normally do the butterfly when you have divorce obligations to meet? Nice, Grant. All right. Yeah, that would be the most common example of when you do a butterfly. All right. That's all good. And in fact, Ksenia, the Peter Nelson case, the case study that's new in advanced curriculum. Are you with me there? That's a case where you actually might use a butterfly because he's going to end up with this messy ownership post. And he's got a business that you could actually break up fairly easily. Okay. Just a rough approximate, Sean, of what small business tax looks like. I would have been happy anywhere between 9 and 15%. Okay. I just eyeballed a small business tax rate. Good. Okay. I just wanted easy math, Sean. Good. Okay. And remember back here, we looked at a bunch of different small business, a bunch of different tax rates. Okay. And I think I have some 12% here. Okay. Although both New Brunswick and Nova Scotia, I have to add a decimal place to, but none of it, 12%. There you go. PEI, 12%. Okay. All right. Yeah, now we'll look at active corporate income. This is probably the last concept we'll get to today. Okay, so clearly I want active corporate income. Remember our tax rates here on active income, we're looking at somewhere between 9% to 30% tax, whereas on passive income, we're looking at somewhere around 50% tax. That's right. And so generally speaking, we want to do as much as we can to make sure that our corporation is generating active income. Now, the most common scenario you're going to run into here, and this ties into a question that came up earlier, the most common scenario you're going to run into that's passive income is rental income. Okay, rental income is passive unless you have more than 5 full-time employees working in the rental business. And they also can't be your family members. So how big does your rental empire have to be to convert your rental income from passive into active? You're not doing that for 7 units, are you? Yeah, how many rental units would you have to have, Melanie, before you hire 6 people? 6 full-time people. Okay. Now, that being said, well, you got to pay them. Excuse me, Stephen, sorry. You got to pay them something, right? Yeah, even a minimum wage, you would have to be paying a lot of wage to make this worthwhile. You're still not doing that for 7 units. Man, I might need it here, Bonnie. My wife is in the next room, Bonnie, but I'm pretty sure she's going to point and laugh if I die here. So, all right. Oh. All right. So the challenge here then is that we want, she's honestly fantastic, Melanie. Yes. All right. So she would probably come to my rescue. Okay. So probably, yes. I mean, consider, Melanie, how fed up you would be with me after 17 years together, something like that. There you go, Bonnie. Okay, so might be 18 years. I don't know, somewhere in that ballpark. So we want to keep income active. And I'm going to show you the case study. This is exactly what you would see if you went to an accounting class today and studied this topic. Nice. All right. And in fact, there's a set of court cases related to this exact thing that we're just waiting to see go through the tax courts related to some Ontario businesses today. Okay. Nice, Stephen. And it goes like this. Let's see if I can make this work. This picture is a mixed bag at best. I'm getting there. Oh, I think I'm doing it. Does anybody know what I've just drawn here? It's fantastic, isn't it, Melanie? All right. It's not a courtroom. Think to like May long weekend here. I can't look at Carla. All right, perfect. It's a campsite map. Perfect. Carla knows. Okay. It's a campground. You can tell it's a campground because it says this is a campground on it. Okay. And that's how I win at Pictionary. So this is exactly what's happened in Ontario. We have a whole bunch of these sort of larger scale campgrounds. There'd be some of these up where you are, Stephen, right? Much bigger than this, but this would be like one little leg in the campground. And the question here is, when somebody rents a campsite from me, is it active income or passive income? Oh, I see. No. Is renting a campsite active income or passive? Okay. Well, let's say that all I'm paying for, okay, so if I'm paying for just a spot to park my trailer or my tent for the night. And that's all I'm getting. I've literally rented a space, haven't I? There's no other services that I'm getting. I'm not paying for anything else except a spot to put my vehicle, my trailer, my tent, whatever I've got overnight. So generally speaking, if a campground wants to be considered active, it has to offer more than this. You can't just be charging people for the use of the space. I want to add some services to this. Okay. And this is something that we really see in campgrounds. Okay, so perfect. Is there a pool on site? Maybe with a lifeguard. If I can get every camper to pay $1 or $2 extra to have a lifeguard at the pool, now we're more into active territory. Okay, if I'm paying for hookups, if I'm paying for power, water, sewer hookups. Okay, now I'm getting a service out of this. All right. Yeah, if I've got a store, if I've got mini golf, if I've got a boat launch. Okay, there, I like it, Grant. I could have some fruit picking. That might be part of my active. Basically, the more stuff that we're doing here, I got it, Grant. All right. The more stuff that we're doing that's active, the more likely it is that our income is considered to be active. Okay. And this is a big deal with these Ontario campgrounds today. Let's say that you have a campground that's been paying tax on, for the sake of argument, $300 a year of what you considered active income for 10 years now. I'll go 7 years. We'll go within the statutory period for 7 years. You've paid tax at roughly, in Ontario, it's been about 13% over that time. That's $39,000 a year times 7 years. That's about $273,000. Wow, that was hard. Versus, right, so just garbage removal is probably not enough, right? So these court cases right now are quite contentious, right? I don't need 5 full-time employees for this, Stephen. So I just have to have services that are active. Versus, although you're right, if I had a campground big enough that I had 6 full-time employees, that would also do it. You're right. Versus $300,000 times roughly 50%. That's $150,000 a year for 7 years. Okay, that's a big difference. So with that water, sewer, and power, Andrew, you would need to demonstrate that those are services you're providing, that they're not just rental. Okay, so for example, maybe what we really charge for is all the work we do related to our sump field or that kind of thing. Okay. All right. Sure. It's just, I'm just adding to the list. Okay. You with me there? That alone is not going to push me over, but I have to demonstrate that when my renters pay their, whatever it is, $30 a night, that they're paying for something other than just a spot to park the trailer. All right. Good. Okay. Now, I'm going to show one other, and at the risk of getting us into a little bit of unfamiliar territory here, I'm going to show one other example where rental income is active income. Well, it's all relative, Stephen. So this is a very common type of arrangement. You see lots of this. I'm going to have now a dentist. Okay. And my dentist is going to be the 100% owner of a normal structure. Andrew, I think this is what you wanted me to do before. I've got a holdco and an opco. And in my case, and I'm going to fix this later on, there's a better way to do this, but in my case, for the time being, I'm going to have holdco own 100% of opco. That's good. So opco is where we offer our dental services. This is where we do all of our billings for cleaning and hygiene and all that kind of stuff. Okay, everybody's with me there? Does that make sense? All right. And then the reason that we have holdco most likely is because, and we're going to do this more when we're together next week, but the whole idea here is that I don't want to sit on cash in opco. Okay. This was your point earlier, Andrew, wasn't it? Cash held in opco is at risk that basically if we have a lawsuit where the dentist accidentally strikes a nerve with somebody, numbs a nerve, something like that. So if we have a lawsuit, the cash in opco could be lost. Okay. And at the same time, we know that if we pay that cash to the dentist, we have to pay about 50% personal tax on it. Is everybody with me there? So I'm going to take that excess cash. I'm going to move it up to holdco. These are what we consider connected corporations. There's more than 10% ownership between the two of them. That is, holdco owns more than 10% of opco. Sorry, 10% or more. Okay. And what that allows me to do is to move dividends tax-free from one corp to the next. So because they are connected, dividends move tax-free from opco to holdco. Okay. And they retain their structure. So anything that would have been an eligible dividend stays eligible, and anything that would have been a non-eligible dividend stays non-eligible. Okay, so we're moving those things up the ladder without having to change their tax characteristics. Is everybody with me there? Okay. Todd, I don't remember. Do you have dentist clients, Todd? Okay. Does your dentist client have this kind of thing? This is very common. Okay, so the monetary benefit here, Melanie, is you're still getting that tax deferral. Okay, maybe one day. So remember that this amount, so my after-tax dollars were only taxed, right? But if I left them in opco, Melanie, and then opco gets sued, then I have a problem, right? So these are still tax deferred dollars. Okay, yeah, so it's not a tax advantage. There is no tax advantage to establishing holdco. That is 100% true. The advantage to establishing holdco is I'm going to continue to get the tax advantage that I get through a corporate structure, and I don't have to peel money out to the dentist and pay a bunch of tax on it. So this is where holdco retains income because it's protected. It's not absolute protection, okay, but it's protected from claims against OpCo. Okay, although there is some dangerous precedent here. We have a couple court cases where we've been able to access that money, and we continue to get tax deferral. Okay. Yes, that is a valid comment, Melanie. So that's where I would say it offers a degree of protection, okay, but not absolute protection. Yeah, so the most famous one is a case in British Columbia, Andrew, where a company had, and before they ever had any risk, and I have it footnoted in the textbook, Andrew, but a company had something like $85 million that it had moved up to Holdco. And OpCo basically started a whole new business venture after that money was moved. And the courts later, and then OpCo got into trouble, and the courts later determined that because and I can't remember if it was the accountant or the tax lawyer, but one of the advisors in the team had said, move money into Holdco because it's creditor protected. The courts determined that there was an attempt to avoid creditor claims, and they pulled the $85 million out of Holdco and put it back into OpCo to satisfy claims of creditors. Yeah, so seg fund in a Holdco doesn't get me any creditor protection, Shauna, because I still have the same limitation there. It's still a corporate asset, and the beneficiary still has to be the corporation, right? If I make an individual the beneficiary, then I have a taxable benefit for the individual, and then I might as well just strip the money out anyways. You with me there? And it will be the same, sorry, just 1 second, Andrew, it'll be the same for your life insurance solution 2 grant. So life insurance held in the Holdco doesn't get me any unusual creditor protection because the corporation is still going to be the beneficiary of that policy. Okay. So it's still, that protection still exists in most cases, Melanie. That case in BC I talked about was really an anomaly, but you still have concerns around that protection. Go ahead, Andrew, sorry.
No, I'm just wondering what your thought, like, why would, I mean, I still don't understand why they would have just, the court didn't come to a decision and they just took the 85 million from Holdco and moved it back to OpCo.
Yeah, well,
Just
that was the
wondering-
decision, right?
That was the decision they made to move it back. I just wonder why, like if.
Because
It's easy to
specifically,
get that they
so BC
didn't
has
look like they were.
yeah, BC has a super aggressive, what's called Fraudulent Conveyances Act, which is the act to prevent you from hiding money in a bankruptcy. Kind of ties into Bonnie's comment earlier about using your corporation to hide money from a divorce. Okay. So because the legislation in BC is so aggressive, the courts looked at how the wording of the legislation was and said, even though that transfer happened before the corporation ever got itself into trouble, the advisor in that case specifically wrote down that you were moving money up in order to protect from claims of creditors. And so the courts determined that to be a fraudulent conveyance. No, your premiums are still not tax deductible, Grant. Yeah, it is provincial, Andrew. It is provincial. So BC is problematic here because of its very aggressive Fraudulent Conveyances Act. Got to be real careful what you're writing that reasons why letter, Shauna. You're in BC, right? Okay. Yeah, we'll talk about life insurance owned in the corporation later, Grant, but no, your premiums are not deductible.
Jason, what other reason would you have a Holdco other than, like, I mean, there has to be others, but I mean, that's the primary reason is to have.
Well,
the
courts would say that they never really endorsed the use of a Holdco. So that might be the primary reason, but there's nothing there that says that there's nothing anywhere in legislation that actually says that. No, that's not true either, Esther. We'll talk about deductibility of insurance premiums, but we're a little ways away from that yet. Okay. All right. You still do the reasons why letter, Shauna, but you better have a reason other than creditor protection to own insurance in your corp. Okay, I'm still getting to my point here. So now I have a bunch of cash sitting in Holdco. And here's what's going to happen. Holdco uses some of that cash to buy the building that's going to house the dentist's practice. Okay, and this is common enough for dentists to own the strip malls that their shops sit in. That's fair. So let's say that we do something like this. We buy a 4-bay strip mall. Okay, and I've got the dentist over here. And then my other bays are, I don't know, whatever we're going to have, a vet clinic and a marijuana shop. There we go. This is the norm now, isn't it? And a coffee shop. Okay. Everybody's with me there? Okay. Could have been a bakery, Bonnie. There you go. Okay. So now OpCo is paying rent for this clinic. Everybody agree with that? OpCo pays rent to Holdco for the clinic, which that would, if OpCo just owned the clinic, there would have been no cost here, right? But in this case, OpCo pays rent to Holdco for the clinic. That's active income for Holdco. Okay. All the other, the vet clinic, the marijuana shop, and the coffee shop, they would all pay passive income. That's all passive. That's rent, and therefore passive income. Okay. All good? All right. Right. So it's a good question, Esther. If the dentist has somebody on their staff who manages those other 3 units, the salary that we pay that person can actually be deductible against Holdco's passive income. Okay, you have to do a little bit of finagling to make that work, but that can be done. It's not bad. In practice, it's not bad, Esther. It just involves a little bit of billing that your accountant will help you with. Okay. Is that a good place to wrap up for the day? Yeah, we're past time, Melanie. I know. All right. Exactly, Sean. Yeah, exactly right. Yeah, rent from OpCo is active. All other 3 are passive. I got it. I know, Melanie. All right. Yeah, we'll see you all Friday. I hope we had fun today. Okay. I hope today, I really enjoy this stuff. I find that this is where we get to do a lot of learning. The problem with a lot of learning is that means that we are stressed, right? That shows up in a lot of other ways. So let's, take it easy. Go to your workout class. That's perfect. All right. Okay. Nice. Okay. No homework yet, Alicia. No homework yet. Homework this weekend. Okay. And it's got to be quick, Sherry, because I have another meeting waiting for me. But yeah, if you're quick, go ahead.
Jason, can you hear me?
Yeah, I'm going to just stop the recorder here.